Good morning. It is my pleasure to welcome you all to the second day of this 8th annual conference of the European Systemic Risk Board. The topic of this year's edition, New Frontiers in Macroprudential Policy, has been a common theme of interest and attention for the ESRB, I would argue, since its very inception in 2010. As authorities and policy makers in Europe have gained experience and accumulated expertise in the conduct of macroprudential policy, particularly in the banking sector, considerable amount of effort has been put to bring up macroprudential policy from its infancy. And this has been done in many different ways, mainly by creating macroprudential space through the build-up of releasable macroprudential capital buffers in banks to flexibly cushion against eventual adverse shocks to the financial system, by implementing an ever greater variety of macroprudential tools, such as borrower-based measures to limit systemic risk related to banks' lending standards and customers' indebtedness, by researching the scarce empirical evidence available and enhancing analytical methodologies to better estimate the impact of macroprudential measures, by developing novel concepts to frame our common understanding of macroprudential stance, and by promoting regulatory amendments with a twofold objective: refine or introduce new requirements to complement the existing toolkit while seeking to harmonize the availability of that toolkit across European Union member states. In this context, the so-called macroprudential policy beyond banking, which was the subject of yesterday's panel discussion, may be seen as a kind of catch-all phrase intended to cover many segments of the financial system, from investment funds and asset managers to insurance and reinsurance companies. In my view, this expression of macroprudential policy beyond banking, which was already used by the ESRB in a strategy paper that was published back in 2016, sets an expectation, or rather quite reflects an aspiration, to take the non-bank financial sectors to a macroprudential level playing field with banking. Available empirical evidence suggests that macroprudential measures are proving effective as intended in enhancing ex-ante the resilience of banks. This is certainly the best encouragement we can get in our attempt to extend the domain of macroprudential policies to all segments and corners of the financial system. In this endeavor, we should harbor no doubts that macroprudential policies for banks and for non-banks would reinforce each other, as the case for regulatory arbitrage and leakages within meanings, thereby increasing their effectiveness. Indeed, depending on the nature of systemic risk, macroprudential measures in the banking sector may not suffice in isolation to fulfill the mitigating or preventive objective. As we know, our regular data analysis shows that there are strong links between financial entities belonging to different sectors. These interconnections, which can either take the form of direct or indirect exposures, unquestionably have some advantages. Most notably, they allow risk to move around the system and end up with those entities that are in a better position to manage it and obtain greater profitability from it. However, and this is somehow the other side of the coin, these interconnections can also become unfortunate channels for the rapid spread of shocks across the financial system. Against this background, the public consultation launched last May by the European Commission on macroprudential policies for non-banks means that the next couple of years will be crucial for any progress in this domain in the European Union. Effective macroprudential policies beyond banking should be capable of targeting the interconnections I was just referring to, as well as addressing systemic resources specific to non-banks, and to this end, we need to work further in designing a new set of tools. Now let me turn to a key issue that macroprudential authorities constantly face: uncertainty. No one can reliably anticipate or predict when and how will the next major crisis affecting the financial system start. For this reason, we so often refer to any lingering or potential threats with the simple expression of financial stability challenges, and indeed it is no coincidence that this wording features in the themes chosen for the last two ESRB conferences. One major challenge that is becoming increasingly prominent in our horizon, both as central bankers and financial supervisors, relates to the adoption of artificial intelligence techniques, AI for short, in finance. As with major technological advances in the past, AI brings both risks and opportunities which at this point we are only starting to foresee. This will be the topic of our first discussion today, which will be led by Andrea Mechler, Deputy General Manager of the Banco for International Settlements. Andrea is very well known for the ESRB community, as she was the first Deputy Head of the ESRB Secretariat a decade ago. We are pleased to have Andrea back today for this conference, and she will be assisted with four distinguished speakers who will provide us with the perspective of industry practitioners and academics, and therefore we'll have the chance to reflect on this important and fascinating topic with very different dimensions and angles. Our second panel discussion today will be devoted to systemic liquidity risk. As you are aware, liquidity strains can become severe enough to eventually affect the financial system as a whole, thus necessitating ad hoc interventions from central banks and other public authorities. For this reason, under the auspices of the Advisory Technical Committee, the ESRB decided last year to set up an agile team tasked with creating a surveillance framework consisting of a set of indicators that can be used across European Union jurisdictions to assess systemic liquidity risk, considering the structure and interlinkages within the financial system. The outcome of this strand of work is due for publication in the form of a report this autumn, and Stefan Cecchetti, a current Vice Chair of the ESRB Advisory Scientific Committee, will today steer the discussion on this very important topic with four exceptionally qualified policy makers. Today's third and last panel discussion will deal with various emerging risks that are relevant to macroprudential policy. In the increasingly complex world we live in, there is unfortunately no shortages of risk and vulnerabilities that may impact the financial system one way or another. From natural disasters to cyber attacks, from pandemics to geopolitical tensions, all these factors of uncertainty demand new and agile approaches and strategies to public policies. Thorsten Beck, current chair of the ESRB Advisory Scientific Committee, will chair a panel that will surely invite us to think out of the box in order to manage uncertainty with a broad perspective beyond macroprudential policy. And between the first and the second panels, the Lecce van den Burg Prize will be awarded to Svetelina Nenova from the BIS for her work on safe assets, which she undertook as a PhD student in economics at the London Business School. Loriana Pelizzon from SAFE Goethe University and current Vice Chair of the ESRB Advisory Scientific Committee will be in charge of presenting the prize, which is the ESRB's annual recognition since 2015 to young researchers in the area of financial stability. Last but not least, the conference will conclude this afternoon, as customary, with the closing remarks by Francesco Mazzaferro, head of the ESRB Secretariat. He will centrally take stock of the rich and thought-provoking exchanges awaiting us today and share with us some insights on the key topics of the panels before drawing the event to an end and inviting us, hopefully, to join the 9th ESRB Annual Conference on 2025. But now, please let me turn to Olli Rehn, Governor of the Bank of Finland and first Vice Chair of the ESRB, who will be delivering today's keynote speech. Olli, you have the floor. Thank you very much.